to trade the market. I know I haven't seen a lot of places offer, talk about it in this way. And I've looked around quite a bit to see how other places trade the futures or talk about trading the futures or look at the market, present the market to others. And I've never really seen this talked about, but I don't understand why you wouldn't want to do it this way, right? We know they move in correlation. We look at the cumulative tick all the time, keeping our eye on what's going on with the market. Like right here, we've had market sink again, trying to turn back up. We're still in distribution in the Russell and in the S&P, but the NASDAQ is still sitting above and never went below the distribution line. The bonds have not rallied back at all. They're still staying flat at these pre-open levels. And this looks like a really amazing bear flag, honestly. The sectors are kind of what's giving it away. If this market needs to reverse or wants to reverse, we're going to need to see the sectors come around and carry the market back to the upside. So until we see that, the financing you can see is up off of its pre-market lows, and it's looking a lot stronger than the others. Finance alone won't carry us though. We need tech to come back in, or we're just going to keep sinking. And at the most, we might be able to maintain our position, but maintaining our position isn't going to cut it today. So we need another sector, another strong sector like the industrials, or it'd be nice to see energy come back. Energy, tech, and the industrials. Those four with finance, this market would move. If we jump back into Market Watch, energy is off of its lows. Still, they were down over 2%, but they're back up to minus 1.13. It's not bad. Industrials is still weak, but off their lows. And finance is off their lows. So when you're looking at these sectors, just look at these upper green lines and recognize how far off their highs we are as well. It's how much of a pullback we've had, presenting that weakness. And we go over and take a look at the Dow. I like looking at the Dow. If you're new to this advanced decline system, start with the Dow. It's only got 30 stocks in it, so it's a lot easier to kind of wrap your head around. And this can give you a really great indication of what's going on in the marketplace. It doesn't always, like I was talking about, Walgreens tipped the market over one day. Walgreens pushed the Dow down over $500 when it missed its earnings in the early part of the year. And the rest of the market was ripping to the upside. So you can't just look at the Dow by itself. You have to look at everything in the picture. But looking at the Dow with only 30, on a day like this when all the markets are correlated, it can give you a really good idea of what's dragging down the market. The Dow is 30. It is 30 stocks. I don't know why you thought it was 100. Maybe there is a Dow 100, because, I mean, there's an S&P 100, there's an S&P 400. Hell, there's an S&P 600. And I didn't know that there was a 600 until recently. So there could be a Dow 100, but the, quote, old school Dow, the Dow, it's 30. 30 markets, and it's these 30. And you should recognize every name on this list. ExxonMobil, Walmart, Walgreens, Verizon, Visa, United Healthcare, Procter & Gamble. These names are the industry standards, right? Caterpillar, Conoco, Goldman Sachs, Harley Davidson. These are IBM, Intel, big names. you should recognize every single name on these 30, and they should all be in your watch list. Right? These are tradable institutional markets right here. Walgreens is down almost 3%, and it's testing that low again, like it pulled back in a fib pull. Dow Incorporated, or Dowcom, pulled back from almost 3% lows. What I'm really looking at personally for me in here is how many are off of these lows or off of these highs, and which two aren't. So American Express is still pushing to the upside, and Visa is still pushing to the upside. Both of them credit markets that I had been watching for the last 2 days get their butt kicked, and now they're ripping to the upside. It's a good thing. Makes me feel good that I had prognosticated that. We were talking in the in chat the other day about this, and the consensus was credit's been doing really good this year. You'd probably be seeing this come back around. So there's your news for Walgreens. Then it's closing a bunch of stores. What the heck? Thinkorswim's a little goofy this morning. So the thing with Visa is you got to recognize where it's sitting now, what it's been going through in the last few days. This could, again, be just like we had the other day on Tuesday, where we had that mid-afternoon rally up, and then the pre-market the next day, and then it dumped. That is a key level, and you can see that it's validated this range now for the second time. Persistence does beat resistance, but I don't think it's had enough opportunity yet. You look back, looking to the left, how many times it hit this same level and failed? Again and again and again. Right? So we need to see a lot of participation come in and get it above those levels. And MasterCard, which wasn't on the list because it wasn't in the Dow, it looks exactly the same way. Just like how we look at the indexes, and all four of them pretty much are correlated, moving in sync, it's exactly what we would expect when we're looking at credit. Same way that the wheat stocks move, the chip sectors, and then you just try to identify the one that's not playing along with the others. You see, American Express, for some reason, to me, American Express looks a lot stronger, even though the dip and the return that it's in is just a bigger version, right? It just moves more. It's got a larger ATR. It's the only difference. But, we carry our biases, and this is one of the reasons it was on my list. Had the 200-day bounce. And so it was on my list for that. Even though it's a sideways market, we don't give a lot of credit to moving averages or the moving average bounce in a sideways market. The 200-day, it's still a brick wall more often than not. Amazon is up 21% today. $21. Where's my percentage? That should be net change percent. 21% in Amazon. That would be amazing. There we go. Amazon up 1.8%. That makes a lot more sense. So we do have some credit spread opportunities, though, at these levels. With MasterCard, for an example, we'd want to see this maintain this position here. Oh, my puppy's got to go outside, guys. I'll be right back. All right, I'm back. So apparently, if I walk away from the computer, things explode to the upside. I might have to keep walking away from the computer. The S&P pushed against this level here. Wow, I missed a pullback on everything. I could have caught that. Could have caught a little bit of fun in that. So if you guys hadn't heard me talk about this, a lot of times we're told to sit out, right? When the Fed speaks or when we see one of these spikes like this. And I argue completely the opposite. With these micro products, you don't have to sit out. You can jump right into it. When you see something ripping parabolic to the upside like that, grab one micro contract and throw it on there. Anywhere. Just hit market order. Doesn't even matter. Just throw on a micro. And right after you do that, put on a disaster stop, say 20 points away, right? And, we name it appropriately. It's a disaster stop. And that way, you can take advantage of this situation to the upside or the downside. When I was seeing things go waterfall 2 weeks ago, every time it waterfalled, I jumped into it. I did not care how far it was going, didn't ask. I just threw a micro on there. Because what's your risk? All right. One micro, 20-point disaster stop. Worst of the worst, you're going to lose $40 if that thing actually comes down. But why would you let it? Why would you let it fall $40 into your disaster stop, right? The idea would be that you're jumping into something that's going parabolic and you're just going to hang on for the ride. More often than not, after a market makes that move, it pulls back real hard. So when you see it topping out, throw a micro on there in the other direction. Maybe it doesn't top out, right? Maybe it only comes down a couple points and then starts ripping back up. Let it stop you out. Get out of it. No problem. But don't sit out. Jump in. Take it for a ride. What's the worst that's going to happen? You know what I mean? But don't go in there with 10 contracts like some Wild West gunslinger. Just give it an opportunity. Take it for a ride. Why not? We can change the rules compared to the way that we always had to do things before, because before the products were too big. It was absolutely insane to try to grab something like that before. You sat and watched it move 20 points yesterday. I was at work last night, and I ended up getting a day job because with the wife not working, she was providing our health insurance. And since she's not working, I have to provide health insurance. So I went and got a real job. I don't get to just stay at home and being a trader. Well, when I'm at work, I talk about trading. Nobody in my company is a trader yet. But of course, I'm promoting the Bullish Bears, telling them, you want to learn? Come on over, start learning. And I brought up the NASDAQ at 6 o'clock, which is our lunchtime. And of course, Tokyo opened and the market ripped to the upside. And since I have Ninja Trader, I don't have a mobile trading platform. And I just sat and watched it run and I couldn't trade it. That sucked. That absolutely sucked. But, 6 o'clock my time, Tokyo opens. 7 o'clock my time, Hong Kong opens. Two different time periods that offer an opportunity to trade. And when I wasn't working a day job, I enjoyed trading them all the time. So just, the overnight hours can get a little slow. And so the market opens for Asia. It can just bring in a little bit of volume and some volatility, get some nice trades out of it. So if you're not doing that yet, perhaps give that some thought as well. Wow, Thinkorswim is just laggy. It's probably my computer though. And just shut down maybe a few of these. Let's see. Shut down a few applications that might do a little better. All right. So now, looking at this, the Russell is the weak one. It came up to these pre-market levels, and that's where it's held its rejection, and we haven't gotten a close above that. The Dow also, it's above these levels, but it's not above that pivot. So the Dow is at least doing better than the Russell from that perspective. Need to see the Russell come back in with some participation. It's basically what we need to see there. Jump over to Market Watch. Notice how many of these red lines are underneath a green market now. So we got a bit of a pop, but as we're sitting here watching it, the Dow is coming back down, Caterpillar's coming back down, ExxonMobil, Walgreens. So we got a little bit of a boost. We're looking at 2010 on the advanced decline. The money doesn't reflect that though, so we got a little bit of divergence in the money. S&P 100, 65-35 or 60-40 be an easier way to think about it. And again, the money flow does not reflect a 60-40. Nothing is really standing out. We do have some that are pressing against the top of their markets. MasterCard, PayPal, Visa. I really need to get more into the digital payment systems. I think I miss a lot of opportunities there because it just trying to lump it in with credit just doesn't really fit for me, and it throws me off. But we don't want to ignore those kind of markets. Paycom, PayPal, there's quite a few of them, and just a little bit of work perhaps to go in and see which ones are even worth trading, which ones have got good options. But credit is still doing good. So now if we jump back to, come on, Thinkorswim, jump back to the sectors. Now we've got a different story in the works. The top 6 are doing really good. The bottom 3 are weak. And the bottom 3, again, are the defensive sectors. Consumer discretionary like soup, bourbon, toilet paper, the important things, healthcare, and utilities. The bonds have not budged at all. They gave a little bit of weakness, and that's it. So through that whole turmoil right there, nothing. The VIX, yeah, we had some spikes. And this is why if you're trading the VIX, you want to have your orders in place. These spikes can get you out of profitable trades. Just, you hit your targets, you're done in the blink of an eye. If you didn't have your order there, you'd have missed it. All right? If you were short in the VIX, you would have missed your opportunity. Now, my comfort level for the VVS is when the market is below $13. So if we can get the VIX down another $1.50, $1.25, I'd be looking to take a VIX trade. I'm not interested in taking one at this point in time, but that doesn't mean that somebody with a little more appetite for risk couldn't take the opportunity here at $14 to put on a VVS. The videos for that are on the Bullish Bears website in the advanced level or the next level training library, including how to set it up, what expiration, what strikes, what deltas, everything you need to know to trade the VVS trade. And it's a great hedge product. And if you look at the SPY or the Qs or the SPX, you would understand why having on a hedge right now would be appropriate. We are back up into these all-time highs, and we still have a lot of economic uncertainty. All right, so anything at all could tip this market back over. Even the news that's coming out right now that's shoveling us all over the place, it's not real. There's no actual policy set. These are just things that they've considered, or they set a date to perhaps maybe talk about something, right? That's just a warm fuzzy feeling. There's no actual situation. It's not like Boeing. When Boeing crashes because airplanes were falling out of the sky. That was a situation, right? Right now, these up moves and down moves are based on the warm fuzzy feeling that the market has or doesn't have. So putting on the VVS at this point would really be appropriate. And also the risk twist spread, like we were talking about, we need SPY with a volatility below 16, and we're there. We have that right now. So if you look at the implied volatility in SPY, well, we had it before the market, I should say. Who knows what we have now? Yeah, we're at 14. That's more than good enough to put on a risk twist spread. And those pay out really, really good. So the hedge is in play. I can't say it any other way, and there's no better time to put it on than right now. If you wait and you miss your opportunity, that's all you'll be saying is, damn it, I should have put it on when. And you didn't. This spike here in volatility, that was a $3,700 payout, and it had a $120 of risk. $3,700 in that spike. So take the opportunity to put on these trades when they present themselves. It's not a matter of if we will get a spike in volatility. It's just a matter of when, because we know it's going to happen. We are above the cog lines, by the way. So that's also something that needs to be taken into consideration. You see these levels that we're pushing against here. When we look left to that 303 cog line and above it, it's almost formed its own gravity point at that level. 3020 would be an appropriate spot for that, for the next line. It wouldn't be one of the formulated cogs that came out of the meeting in 2018, but it would still be a pretty decent level to keep your eye on. So small cap is where we've got our weakness now in the market. The Russell is no longer the bird dog. The S&P has taken control again, and it's been a long time since I've said that. The S&P typically drives order flow in the marketplace, but lately it has not led us anywhere. It's been following the other markets. More often than not, lately it's been the Dow, the big blue chip companies, the big dogs in the market that's been leading the way. if you use the NASDAQ as an indicator like I do, I'm looking at that 79.75 level. We need to see the NASDAQ break that quarter, that quarter level. To me, using the NASDAQ, I use it just like other people use the stochastics or the RSI. I found the NASDAQ to be a really great indicator. You would play it with the risk twist spread, and there's a video for that on the Bullish Bears website under the advanced level area. The risk twist spread is a hedge. It doesn't have to be a hedge. You can use it for a hedge, or you could use it just to play the volatility, but you can't use it for both. Right? So if it's a hedge, use it for your hedge. If it's a volatility play, just use it for the volatility play. But you can't you can't hedge with a risk twist spread and use it for a volatility play. So if you do use one for just a volatility play, you could use the other one, the VVS, for your hedge, or vice versa, right? Both of them are hedges, and both of them are volatility plays. So you could use one for one and then use one for the other. So when you go over to the options tab and you scroll down, you got your VVS, the VIX volatility spread, part 1 and 2, the risk twist spread, and the back ratio. Now, I'm not a real big fan of the back ratio when you put it into the risk twist spread. You can combine these two. I don't like to do it, but you can. And what happens is you create a U shape in your risk curve. So let's go to SPY. Can't believe how laggy this thing is today. Oh, come on. Wow, that thing moved in slow motion. December, we got to make sure we set this for 20 December. This upper right calendar is what will project the expected move. And this calendar is how you walk through time. So if you want to see what your trade would be worth 5 days from now, you would walk forward your time frame here. Boy, this thing is just a laggy beast. So that's your upside for the back ratio. And it's also affected by volatility. So the idea would be your risk twist spread would have that unlimited move to the upside in volatility if the market fell, and you would have unlimited move to the upside if the market rose with this back ratio. The reason I don't like it is typically when the market goes parabolic to the upside, volatility doesn't rise. It can. We've seen it happen, but typically when price rises, volatility falls. And this is a volatility play. So yes, the back ratio will make you money because price is moving higher, but it's not going to get the same additional bonus or additional funds from the volatility spike. But the reason people like to combine the two is because typically when you put on the risk twist spread, you put it on, say, we're right now at SPY 301, and the market moves to 310 before some economic event tips over the market. Well, if you put the risk twist spread on down here, the market would need to fall those $10 plus some before you start seeing profit, and then your curve would be moving to the upside. Now you can see with the way that I've got vol step showing, I'm adding 5 points of volatility per line. The yellow line shows us with an increase of 20% implied volatility. Just stopping my mouse right where it's at, you can see that this would be a $1,200 trade to the upside from nothing more than volatility going up. So it's a really great example of how volatility can really help you in your trade, even without seeing any movement in price whatsoever. I like the back ratio. I just don't like the back ratio connected to the risk twist spread. I don't like to pair the two together. But this is definitely the time to be putting those on. The VVS and the risk twist spread. And you can put it in the Qs as well. The same with IWM. And I'm biased on the IWM. I have been waiting and waiting and waiting and waiting for this thing to come back up to last year's levels. And instead, it's still struggling just to get back above this year's levels. And if we widen this chart out with another year of data, yeah, we'll use weeks, why not? You can see how far off we are from last year's levels. So I did put on a spread when IWM came up. I had a spread on in here. This was back here, but it was around the 149. I think I got it for 151, something like that. So I got a little bit of profit through this mess. It wasn't that bad, but I had intended to see a move back up into this range, and I didn't get it. Still waiting. So I'm biased. I keep expecting IWM to offer that opportunity, and it continues to be a dog that just can't get out of its own way. It does have some elevated implied volatility still, so you wouldn't want to put the risk twist spread on in this market. You got to wait for it to get down a little lower. And for the Qs, it's also not low enough. So you wouldn't want to put it on in there yet either. And we might as well, while we're here, take a look at the weekly expected move and try to identify if we've breached the upper expected move yet. We are hitting it now, or we hit it and fell back from it, I should say, since we're on the weekly. things can get a little cluttered. So if I just zoom in close, this is the only thing that we really need to pay attention to. There's the upper range of the expected move, and there's the lower range of the expected move. So you can see we breached it today. One really great trade that you could put on with very little risk would be the low probability butterfly. And you would want to pin it right at the 302. You could do the 302 half, but either one of those I think would be appropriate. The reason we want to focus on the expected move is because of I just deleted one of my cog lines. It's because of the market makers using that where they sell their strangles. They sell their strangles at one of the expected move, and then they trade futures products to remain delta neutral in their strangle. And they'll sell like 1,000 of them, right? They'll sell 1,000 SPX strangles at one of those expected move markers, and then they'll remain delta neutral in their futures. The market makers, well, you are a market maker if you go in and you sell options against something that you own, right? Then you're a market maker. Anybody who is creating an option or putting an option on the market is a market maker. More often than not, I use that term a bit loosely, kind of sloppy, but the trade firms, for an example, the people that are hired to trade other people's money, they'll go in and trade these in that strangle, and they'll do it week to week. And the idea is very simple. If you're the seller, if you want to sell options, you could go out here and you could sell this option for $1.82. You only get one opportunity for the month at $1.82. That's not bad, I guess, right? If you went and did that. But you could sell it 3 times in a week. So you could sell it here, 71, 3 times in a week. And then there's 4 weeks in a month. So 4 times 3, you could sell it 12 times at 72 cents, or you could sell it once for $1.79. They'll go in and they'll sell it 3 times in a week, or they'll sell it once a week. They'll use Friday's expiration, which is what we're focused on. So they'll go in and they'll sell it at $1.55 for next Friday, and then they'll do that again 4 times in a month. So again, way more money than once a month at this price. So they'll go in and they'll sell that strangle with Friday's expiration, like 1,000 strangles, and then they'll go in and they'll neutralize their delta by selling S&P futures against it, because S&P futures have a hard delta, not a soft delta. And that will allow them to remain delta neutral. The problem is, when they do that, is if the market breaks above the expected move, they go in and they have to sell their S&P futures, or excuse me, they have to buy more S&P futures to bring their delta back down. And then, of course, the more they buy, the more the market pushes farther away from the top of that expected move. And then the more they buy, and then the more it pushes, and then the more and it can turn into a very vicious cycle, which is what happened back in October of 2018 to the downside. It broke below the expected move, and the more it fell below it, the more they needed to sell to get delta neutral, and the more they sold, the more it fell below it, and it created one hell of a mess. Yep, you'll have to watch the full video, Gus, but the max loss is not what we wouldn't even consider the max loss, right? You look at about 2/3 the width of the spread, and that would be your appropriate level to bail, right? You don't want to just sit in that thing all the way up until expiration. And time-wise, if you walk through time with the risk twist spread, the max that you would be looking to take is 2/3 the width of the spread as a loss. But we wouldn't even accept that. And on Thinkorswim, when it comes to, there are trades that you put on that'll have like a minus credit, or it'll have a minus debit. Thinkorswim can get you all jacked up on that. It can just really make things very confusing, because it looks like you have a credit and yet you're a debit, or it looks like you're a debit but you're a credit. And what it's saying is inside of there's a credit spread or a debit spread, but then there's also a single option. And Thinkorswim doesn't do a good job of explaining that. So I'm looking at the S&P 100 here, the advanced decline line. We're sitting at a perfect 60-40, and the money is nowhere near a 60-40. The declining money has grown quite a bit. So a little bit of something to keep your eye on. Yep, in the full video, I did cover exiting the position and understanding what your actual risk is and how much we would look to completely take as a loss. I have never been able to trade a risk twist spread. I don't have an account large enough to maintain the buying power to actually trade one. But every time it gets to a level where I put the trade on in my paper account so that I know what the payout is. Because getting people to trade it, it's like pulling teeth. This is one of the best trades out there, and yet people just don't want to trade it because they think, I don't know what the hell they're thinking. People with big accounts should be trading the shit out of this thing, and they don't. So I put on the paper account trade whenever it's at a level that I feel is appropriate, and then I look to see what the payout would have been, and I advertise the hell out of that instead, because money seems to get people's attention. The last time it spiked, that was $3,700. If I had put the trade on in my real account, that's what I would have closed it for in profit. That's a nice trade. Yeah, and it had $120 is what it took for me to enter the trade, and it had a $3,700 payout. So if me advertising it from the rooftops doesn't do any good, then perhaps me advertising what the payout would have been might get people's attention. Exactly. That's a really good payout. And if you look at 20 years of history, there's never been a full year where there wasn't at least one payout. And it really isn't an expensive trade, but it does have a lot of buying power with reduction, and that's what keeps me away from it. I can't maintain that buying power in my small account. Yep, it's got a very hard buying power reduction, and that's unfortunate for people with small accounts like me. We just don't get to participate, which is why I focus on the VVS in my account, because it's a lower buying power reduction. But I have tried and tried to get people to focus on this trade. We don't ever want to say things are guaranteed in the marketplace, but one thing we know for sure is that volatility will always come back. If you take a price trade, you're always wondering if price is going to go up, is price going to go down, what do we know, what can we prove, what about tweets, yada, yada. All of those things come into effect when it comes to price. But when it comes to volatility, it's just a matter of time. Sooner or later, we're going to get another spike in volatility. We all know it. There's nothing we can do about it, but what we can do is participate in it. And look at everything right now with all this uncertainty. Volatility is just waiting to happen. We can also go in and we can look at VIX futures, and we can look for backwardation or what's that? Something tango. Backwardation is as good a word as any for me. Well, we can look in here and try to identify if there's inverted skew. And what we want to see, what we should see, is the farther out in time we go, the higher the cost is for these futures options or these futures contracts. And we can see that right now they're about appropriate. The 30-day level, or the 34, this 31, is one that I always keep my eye on because that matches perfectly with where volatility is calculated in the SPX. That's where contango. Thank you. Yep, that's exactly the word I was looking for. So the 19 VIX here, this 34-day VIX, it's the one that I watch all the time. VIX is calculated from 30-day SPX bid-ask spread, so it makes sense for me to watch this one. But I always compare that to the current VIX price because I want to identify if this front expiration contract is at a higher value than this back one. If it is, then we've got inversion, right? We've got skew in the wrong direction. It's a kind of a heads up. Not necessarily a trading opportunity per se, but it offers perspective. And a lot of times, that's what we're missing. I get emails from people all the time asking, why did this trade not work out? And new traders are really good at picking great trades. But when they fail, they're not real good at identifying why did it fail. More often than not, it's because of something you're not looking at. Say you take a trade in AMD, everything looks like AMD should go up, and then AMD ends up going down. And you're thinking, well, what the hell happened? Everything said it should go up. And then you find out maybe it was a Yahweh thing that tipped over the chip sector, and the industry went down, which pulled AMD down with it, even though AMD wouldn't have had anything to do with Yahweh or. And so it's that kind of external perspective that new traders often miss. So then they think they hit it right. It does completely opposite of what they think. They can't figure out why it went wrong. And then they just sit there thinking, man, I suck at this. I thought I had it all figured out, and it went wrong. And it turns out they weren't wrong. They just weren't able to identify the rest of the picture. Energy is way up off of its bottom, still in the negative, but it's doing better than it was. Financials also off their lows, but still negative. And the industrials. The industrials hold a lot of power in the market, believe it or not. Absolutely. Absolutely, Vulcan. And a lot of times, well, in the last 2 weeks, we've talked about it a lot. I was getting emails from people who were upset that they just couldn't trade in this mess, right? 2 days up, 2 days down, 3 days up, 2 days down, 1 step forward, 2 steps back. And not only were people taking trades that were just too big, they weren't able to maintain their positions, but you're dealing with a market that's affected by every bit of news, every tweet, all the market instability. Trading something like SPY or anything that correlates to SPY is going to cause that, right? And yet, if you just look for a trade that doesn't correlate to the indexes at all, you've got a really great opportunity. And there are a lot of markets right now that have no correlation at all to the indexes, and they're doing great. We were identifying those last Wednesday with the 52-week high, 52-week low scan. Just a basic, simple 52-week scan. Wow, TripAdvisor. Maybe it's just forming the handle on that really big cup, but that looks like a hard fall right there. Here's another one of the energy markets that has not found a bottom yet. I don't even know that one. I haven't worked with that company before. Trying to find a trade opportunity in here, but so far nothing's catching my eye. Not for a swing trade anyways. This RSI showing here in the green, it's a 5-minute RSI. Maybe we'd get a little better luck or a little better opportunity if we adjust this from a 5-minute to a 30-minute. It'll take a moment. Wow, that didn't take as long as I thought it would. Every day is a good day to employ a disaster stop in the futures market. I learned that the first week when I lost half my futures account. Never again will I trade in the futures without a disaster stop in place. And we still do have economic news that should be coming out today. I don't think we've got it all in yet. If you don't know where to find that, go to Market Watch, go to the calendar, uncheck the box that says Show All, and then just click on Economic Events. So we still have the 10-year tips, we've got the bill announcements, we've got auctions, and we've got a budget and the Fed balance sheet and money supply. Thankfully, I quit trading at the bell. I was up in the pre-market on a micro, no less. I think I made $130 on micros this morning. I'm okay with that. I'll just stop. I've learned not to try to live stream and trade. It doesn't work out too good. And so I'm day done. I'll just call it quits with my micro at $130 a profit and be good at it. These are some really wild moves. And like I said, in that waterfall, you had an opportunity to just throw a micro on and take it for a ride. There's no reason to just sit and watch it fall and not jump in with a micro. Because the micro isn't going to break your account. I mean, when we were waterfalling 2 weeks ago, I was making $150, $160 trades in one micro at a time. Just seeing the market falling and I would jump in for the ride. I didn't care. You risk $20. It's not going to blow up your account to risk $20 and take it for a ride. But these are some really big whips. There's no amount of technical analysis that can prepare you for this because the technical analysis is thrown out the window when we're dealing with market that's hypersensitive to any type of media. I believe I've seen a post that said something about White House officials denying interim deal. Gust posted that, and that would explain what happened there. Now, for me personally, this has nothing to do with the Bullish Bears. This is my own Discord, but I only offer it to people who are in the Bullish Bears community. It's free. I don't want any money because I'm not offering any kind of trade alerts or any kind of trade services or anything like that. This is just free content I found on YouTube and other websites, and I post the links in here. You're more than welcome to come and join and learn about whatever, right? Whatever's in here. Help yourself. But recognize that, one, this has nothing to do with the Bullish Bears, and two, that you won't get any trade alerts or trade announcements or anything like that because it's not meant for that. It's just my own personal Discord. But the reason I brought up Discord is because if you follow Twitter, like I was talking about, you follow all of these, like Benzinga, Market Watch, Cryon Research, Live Squawk, Stock Twists. You can follow all of those Twitters with a Discord. So, like, I'm in different Discord communities, and they've got those Twitter feeds linked into the community, so I can just see at a glance what's getting news, earnings announcements, swing trade from swing trade bots. I can see all of those at a glance. This is a really great way to stay on top of the market news without having my phone blow up. I can see the Twitter feeds. I can see enough of the Twitter feed to see what I need to see without actually clicking on the link and going to read it. So I like Discord just for that opportunity to follow. A lot of these places like Benzinga or Black Box Stocks or Cheddar Flow, you got to pay for those services. And I don't want to pay for those services. So, I can go in here and follow their Twitter and not have to pay for a service, right? They just put out a Netflix sweep. Great. I didn't have to buy it. All right. And Benzinga, maybe if you bought it, you would get more out of it. But, I'm okay with free. Run the Discord link will take you to my Discord where I've just collected a bunch of educational content. Swing trade strategies, learning price patterns, and it's locked down to where people can't add to it. It's not for you to add, it's just for you to learn from, right? So if you follow that Discord link, that would bring you to my Discord, and then from here, once I approve you, you would just be in the Discord. There is an area in the lounge where people can chat, communicate, share things, ask for things that I might not have in here, and it's a work in progress, so I'm always adding to this. But when I was learning, say, price action, there was certain people that I would watch their YouTubes, and it's how I learned. So I would remember where I got it so that when I was trying to teach somebody else, I could say, well, I was watching this video from Trade Academy and they were talking about whatever, because I don't want to steal somebody else's thunder, right? If they made it, I want to give them credit for it. So I was saving these links in a text document. And after a while, I started putting them into a Discord, and then once the Discord got really big, I thought, maybe other people would probably like this as well. No, this has nothing to do with the bullish bears whatsoever. This is a trading, it's not even a trading. This is a social media platform called Discord. So if you download Discord or if you join Discord on the Discord website, it's like joining Facebook, right? It's just a different form of media. So you join Discord, and then you could join this channel in Discord. But it's not Bullish Bears at all. Another options channel is the name of it, and the link is where I posted it. So if you just scroll up underneath my name where it says Discord, click on that, that would take you to this. It's still a work in progress, so it's still growing. I keep adding content that I like, and haven't had a lot of time to really create any videos lately, but I have every intention when the wife comes back home of getting back into recording videos, and I will be adding my own content to that as well. Walgreens is still pressing against the bottom of the market. And that is not Walgreens. WBA. I don't know why I put a T in there. Walgreens is a big dog, so it might be getting punished in the next few days because of the store closure, but I would be keeping my eye on it to start finding support. Man, not yet it hasn't, but I'm not looking to trade that sucker short. For the end of the day, you could easily put a credit spread in place above it. You probably wouldn't get a very good pricing on it, though. Your better opportunity in a situation like that would be to put a credit spread underneath it. More risky, but better payout. And I wouldn't use Friday's expiration either. Say like a credit spread below $55. You're definitely standing in front of a freight train to do something like that. The idea being that it's the 5% rule that they talk about on tasty trades, buying into weakness and selling into strength. What should give you pause when you're thinking about doing something like this is looking back here. This wasn't an earnings situation. This was news related. And it didn't just fall one day, many days in a row. All right. And that could absolutely happen here again. Looking at a target profit of around 40, 48, 49, right around in this low. If you look at it from a channel perspective, and if we ignore the news and just only look at it from a channel perspective, then we have a channel failure. We know channel breakouts fail over 80% of the time, and this would be exactly the same thing. We would be trading it from this level back down to this level, to the 49.5. That's actually not a bad play either. We can go take a look at that. Go 40-something days out, take it at the money to get a pretty good pricing. That's it. Ah, come on. We can do better than that. $2 wide trade for $1.05 credit. That's perfect. What we would need to see out of this is for the market to get below 54.5. So if we turn the vol step back off and just put it back on a regular cycle here, we would need the market to get below 54.5. And we've got plenty of time for that to happen. You can see that this is an October 25 trade. We have October 26 up here. The expected move in the implied volatility is this gray box. And we can plot that onto the charts. So if we just delete that middle slice, I should have waited. Now we'll delete the middle slice. Set those on the chart. This makes it easier to see the expected move. This line was mine, and this line is mine. So I'll just change this one to some other color. The two orange lines is the expected move between now and the end of October. So you can see that the bottom range here, which is our target anyways, is well within the expected move. That would be the $50 target, right? It's a nice $5 move, $5.50. And all we need is for the market to get below 54.5. That's a great value right there, $1.07 for that credit spread. Good pricing. But if you also want to be a little more aggressive and perhaps take a debit $2 wide for a $1 pricing, awesome. It's not very often you get the such a great price. Now this one, the more it moves, the more you would make. In the other one, you would just get to keep the full credit as long as we get below 54.5. Now, if you're unfamiliar with options, this might explain why we would want one over the other. Both of these need the market to do the same thing. It needs the market to fall. Both of them will pay out about the same too. If I have a $1 credit in a $2 trade, or a $1 debit, I should say, in a $2 trade, it forms a box. If I have $2 here and one of it's debit, then the other is profit. And you can see the max profit's $1. The problem is you won't ever hit the max profit in a debit spread. You can't hold it into expiration. You can hit the max credit. All you got to do is let the market drop below 45.5 and then just stay in the trade and let it expire. I've got a Q trade on right now that I'm going to let it just run into expiration and take the whole trade. So both of these would be appropriate. One would just pay better than the other. One also needs less out of the market than the other. Because with the debit spread, you need price to move. So if you're asking the question, well, why would anybody want the debit spread? Why not just take the credit spread? Well, because with a debit, you don't need time. If the market falls $4 more rather quickly, you can get your payout at your 60-70% profit and be done in the next 2 days. With the credit spread, you not only need price to get below 54.5, you also need time to go by. And it's a late October trade, so you could be sitting in that thing 3 weeks, 4 weeks before you start to see that 50-60% profit. So if you want a quicker turnaround and you think this market is headed south at a pretty good rate of speed, take the debit spread, you could be done quicker, right? But with the credit spread, you're going to have to wait on time to go by. So that's the distinction between the two. They'll both accomplish the same thing. Now, speaking of SPY, we know that we just tagged the expected move before the flip, before we came back off the highs. We could go in and put on a really cheap trade at 302 with a butterfly. This is a $20 trade. That's it. And $20 is the most you could lose in this trade. 19. Maybe you can get it on sale and get it a little cheaper. The payout on this, not that good. Why is that? Should be better than that. This is a $1 wide butterfly. Oh, so it's the payout's not so good because the probability of profit is a lot higher than what we normally focus on. Normally we focus on a 12% probability of profit. So with a low probability trade, we get a really high payout potential. This has a higher probability of being profitable, so they offer you a lower payout profit zone. Looking at that, you're looking at 100% profit, right? Because you won't hit the 60s or the 70s or the 80s. You'll hit somewhere in the 40s or 50s. Unless you play chicken with the close and hold it moments before the bell before selling tomorrow, then you could have an opportunity to perhaps hit that 70 or 75 range. That's a pretty big risk. When we have a butterfly that has a probability of profit above 20%, then we're looking at a lower payout. And we only aim for 100% profit in a 20% probability trade. Below 10, we would be looking for 300% profit. take the same opportunity in the Qs also. And if you take the lower side, say 301, actually it's not even the low side anymore. The market's down to 301. So we could go to $3. We'll just do that. You could buy the butterfly from the put side at a lower market and still a $1 wide. It's $15 a debit. That's the most you can lose. For this trade, we would need to see the market fade down to in between 299 half and 30 half. Either one of those would still show you some profit. These butterflies have paid out real nice, but the reason I kind of stepped away from them lately is the market makers, the individuals that control the volatility calculations, they have been horrible at identifying implied volatility. The most accurate implied volatility expected move is SPY and the SPX. They're experimental options. There's nothing else on the market like them. And they are typically well above their 68% accuracy. Lately, they've been below 50% in their accuracy, which means you're better off flipping a quarter to identify how far a market can move than looking at the expected move. No, it's not a stupid question, and you don't have to wait either. Say, for an example, we go back to that credit spread. We'll just go back to Walgreens, because I believe I left them on there. Yeah, profit. I don't need 100% profit. Oftentimes, we only aim for 50 or 60% anyways. Well, if it's $1 credit and I only want 50%, I'd be looking to close the trade at around $52 in profit. $52 in profit, that would be right there. So if Walgreens fell to $51 today, I could close that trade in 50% profit today with a credit spread. So you can earn your profits in a credit spread with price movement. But more often than not, you need time to go by so that the options lose value through time. And that's typically how we trade the credit spread. But see, there's a lot of different ways to trade premium, and it doesn't always include time. And sometimes it's only looking at price. When you get the two together, when you get a move down and you get time to go by, then you get the opportunity to collect all of it. The difference being with the debit spread, you do need price to move to see profit. But also, often overlooked in the debit spread is, if you look at this, all I need out of that debit spread is for price to get below 54.5, which is exactly all I needed out of the credit spread. So here's something that most debit spread traders fail to realize. If the market only goes to $54, right? That's $21 out of the 100 that we could make. That's what, 20%? That's not worth it. And they're thinking, man, I should have went with the credit spread. Well, if time starts to go by and we watch that green line, that's our profit line as time moves by, just like with a credit spread, only the debit spread. I lost my feed. It's been a long time since that happened. All right, let's try it again. Been a long time since my internet dumped me in the middle of a live feed like that. I might have to just refresh the room. Yep. Man, this is just a mess. I wonder what happened to my internet today. Ever since the upgrade, I have not had this kind of problem. Do-do-do-do. All right. Well, normally we'd be done streaming at 11:30 anyways, or 11:15 anyways. So it's not a bad time to end it. I just would rather have finished this explanation because I think a lot of debit spread traders really miss this concept that if time goes by, just like with the credit spread, they will be profitable if they just hang on and wait. Seems like there's something wrong with the swing trade room. I'll try the day trade room, see if we can load into that. Nope. Oh, it might not be my stream after all. Well, everybody, that would have been the end of the stream anyway, so I'll just finish this thought on the live stream through the YouTube, and we'll call that good. Yeah. So what I was saying is, just like with the credit spread, where we needed the price to move down below this 54.5, and we needed time to go by, the same is absolutely true with the debit spread. But a lot of traders just fail to recognize a debit spread's connection with time. So if the market did move down below 54.5 and stayed there and you just let time tick by, as I keep moving through price or through the days, then you can see I'm getting more and more profit out of that trade. That green line is starting to form that shape, right? This would be that 54.5. It never moved, right? And this 54.5 right here, if I change that to a 0, that price slice, look at the profit zone. Every day that went by, that profit got higher and higher and higher. So when I start going back the other way, you can see it gets lower and lower and lower. I think so many people who are trading debit spreads fail to recognize that truth, that realization. All right, so thanks for the heads up on YouTube. I was not sure if I lost that stream or not, because at first I really thought it was my internet, but it's the Bullish Bears website that's down. Their live stream is dead. Not sure what happened there, but the site is up, just not the channels. Which is a good thing, because when I upgraded my internet, I was assured of some serious connections and not getting dropped anymore. So when I seen that drop, I was a little frustrated. It's not me. It is the Bullish Bears live stream room. So yeah, still got a lot of trade opportunities out there. Recognize that we do have the Fed speaking next week. And so any of your swing positions, if you were bearish before last night's explosive move to the upside, don't close your positions. we could absolutely come right back down again. So duration over direction at this point, if you were already bearish, don't bail out of your bearish positions. Not yet. Maybe go in and buy some more time, roll them forward, hang on to them, and give this market an opportunity to fade back down, which it absolutely could next week when our Fed speaks. We're always a week off from the European Union. We heard Mario Draghi this morning, and so, we'll be doing ours next week. This could come right back around. If you're not yet in a trade, the VVS and the risk twist spread are both hedge triggers that are in play at this point. Either one could run. So take the opportunity to learn the risk twist spread. No, I live in Kansas, so I was dealing with Eagle Communications for my internet, and I had my own wireless router, which was causing the issues before. They don't sell routers, they don't rent routers, they only sell them, or vice versa. Either way, they said I won't have any more connection issues. Live streaming would be solid, and if I had any issues, they would fix it, and I wouldn't be paying for the month's service if I have any issues. So Eagle Communications pretty much runs Kansas, and I'm more than willing to hold them to their word and not pay them for this month's service if it was on my end, but it's not. It's on their end. If you're looking for trade ideas, try to find things that are not correlating to the market. And it's a key takeaway that we often overlook. The biggest names always get the most attention. This watch list has been one that we've been building for Thinkorswim. That it's a 280, 290 markets. They've got pretty decent options in here, and most of the things in that list correlate with the market, so it doesn't avoid the current situation. But if you want to avoid the current situation, use the indicator correlator. Correlation. Nope, not that one. Comparison. It's already set to the SPX, so just go in and change the line to a candle. Go into your settings and activate the left side of the axis. And now you can see SPY overlaid on top of whatever market you're looking at. This can help you identify if you're correlated. And the other thing you can do is run beta. So if you go in and you type beta, a beta of 1 shows perfect correlation. So one way to test that, we're looking at the SPX. If we go to the SPY, you can see they're perfectly correlated, as they should be, right? The SPX, the SPY, they're sisters. They're kissing cousins, so to speak. So anything that you want to see correlated with or not correlated with SPY or the SPX, go in and you can just check their beta. STZ, Constellation Brands, is in no way correlated with SPY. You can see it's got a 0.5 beta. You can also see that while SPY was moving to the upside, this has been moving to the downside and has been consolidating at that breakout range. This can help you avoid everything that's going on in the market. You can avoid tariffs. You can avoid the Yahweh situation, the European Union, bonds, all of that, by going in and finding things that don't correlate with the market and then trade those instead. If you also take the opportunity to just go to the weekly charts, things stand out easier for you to see at those levels. Take Walgreens for an example. It's down a lot out of that move up. That's that fake out breakout that we were talking about. But it's very easy to see it on the weekly where our levels are at, where we would look to trade this. Boeing, again, really easy to identify these levels. So finding trade opportunities right now would just be trying to find anything that's not correlating with the market. They've been doing a lot better trade-wise than everything else. And it makes sense because they're not, the market is hypersensitive at the moment to social media. So anything that's not correlated to the market would be avoiding that hypersensitivity. And that's it for me, guys. It's 11:30. I'm going to duck off of here. Appreciate watching the stream. Stop by to the Bullish Bears website. Sign up for a free trial if you're not already a member. And the Next Level Training Library is full of options material that has been developed by me and Dan and Creed. It covers advanced level options education for spreads material. This material is not your typical everyday, this is a debit spread and this is how we put it on. No, these videos will tell you exactly what debit spread to put on, how far out in time, what you should do if you need to roll it. It will identify the deltas to use, all of everything that you would need to know, including how to calculate your probability of profit, is explained in the videos. So like selling out of the money credit spread part 3, it's called the income credit spread, but it's also the gold standard credit spread used around the world. The same with the debit spread. I had to name it something, so I called it the Greek neutral debit spread. But it is the industry's standard debit spread. It is the one that you would want to use most often out of any other debit spread. There's times to build them all the way in the money. There's times to build them all the way out of the money. But 99% of the time, it would be this one particular debit spread. Once you learn how to identify the right price so that you're not paying too much, then you've really conquered the biggest dilemma that new traders make when trading spreads. But there's the iron condor, legging into an iron condor, weekly trades, which we've backed away from at the moment since the expected move has been so horribly miscalculated in the last 2 months. The back ratios, the VVS, the risk twist spreads, my own version of delta, gamma, theta, and vega. So everything in here is advanced level options material. This can be used by people who are newer because everything you need is in there. But it's advanced level stuff. All right, that's it, everybody. Have a good one.